There comes a time in every crypto trader's life when it seems as if the sky is falling. Your wallet, which seemed to be in good shape only days or even hours before, has turned red as a result of price action that resembles a brick thrown from a tremendous height down to the ground. Panic creeps in. Your heart rate soars to new all-time highs, and all you can think about is how much worse this is than the zombie apocalypse, as your inner voice tells you to sell now. You've just had your first taste of market capitulation. It's brutal and merciless, but don't despair. Don't worry. Watching this video to completion, you may able to give yourself a day off from thinking about it. Hello and welcome to today's video. We will look at one of the most controversial recent happenings in the world of crypto. We will dig deeper and understand whether crypto capitulation has a bumper solution or not. Before we do that, a sub to the channel will be highly appreciated. Without further ado, let's uncover this topic. To begin with, let's take a look at the meaning of the term capitulation. It has a plethora of delightfully evocative meanings. The Cambridge English Dictionary defines it as accepting defeat. In contrast, Merriam-Webster defines it as surrendering or yielding. Still, neither of these definitions comes close to the Urban Dictionary's wonderful definition of capitulation, which they aptly define as becoming someone else's girl. However, none of these relate to crypto. So what does it really mean when it comes to crypto? Capitulation is defined in crypto trading as the widespread liquidation of a decreasing asset at a loss. To put it another way, everyone is panic selling as quickly as they can with their metaphorical hair on fire. Crypto market capitulation occurs when there has already been some form of a slump, and traders suddenly reach a point of surrender en masse. They sell, often at a loss, which drives the asset's price further down. As more and more holders panic sell to get rid of their holdings before the market falls, the market becomes a playground pile-on. Capitulation isn't rare, particularly in the unregulated and often volatile cryptocurrency markets. For example, in 2015, 2016, 2018, and most recently in 2022, Bitcoin witnessed many significant market capitulations, and smaller and more frequent dumps occurred with worrying frequency. It keeps falling, and falling, and falling. Then, seemingly out of nowhere, the price strikes a bottom, and instead of going splat, it has a rather amazing rebound. While this provides some temporary relief, it often heralds the reversal's second and perhaps most cruel aspect of a market that has just capitulated. As the price finds its low point, it bounces back up north, printing massive green candles and occasionally even heralding a move to new all-time highs. When the market runs out of sellers, those who are holding, come what may, just aren't selling and everyone else has already gone, more pragmatic traders see a magnificent and golden chance for a nice dip buy, and money begins to flood back in. Those that panicked and sold on the way down now find themselves on the other side of the coin. They not only sold at a loss during the rapid decline, but now they're trying to get back in as the price races beyond the low point at which they departed. Greener investors, on the whole, spend a lot of time berating themselves and having major could have, would have, should have meltdowns at this stage. If there was ever a period when folks new to crypto trading would usually quit completely, upset with themselves for losing their money, it's now. So, what causes crypto market capitulation? Although there are various technical reasons why markets succumb, this phenomenon often occurs after a long period of a market turndown. Poor performance, unfavorable news about a project, or even FUD elsewhere in the crypto market, such as delays, hacks, rug pulls, or even a dismissive tweet from Elon Musk, may all contribute to negative sentiment, resulting in a mass exodus of crypto investors. But the fact is that surrender is almost completely down to human psychology and the abrupt shift in power from the diametrically opposing emotional impulses that determine cryptocurrency pricing, as greed gives way to fear. Many investors are concerned about not being able to recoup their original investments. They don't always perceive the token they've invested in as having a future, but the overall impact is the same. When the first cracks appear, They get concerned about being a bag-holding loser, the man who failed at crypto, and their ego compels them to get the hell out of there, lest they wind up with even worse losses if they don't depart right now. Capitulation does not occur gradually over a long period. It happens rapidly, abruptly, and forcefully, with the adrenaline pumping to a climax. This leads the large red candles to become larger and longer, creating a vicious cycle in which many similarly panicked traders dump their assets, increasing the velocity, speed, and quantity of selling. That's not to suggest that big dumps don't happen when a project fails and goes to zero, like the Terra ecosystem and its algorithmic stablecoin UST did in May 2022. Thankfully, these events are infrequent. Part of the problem is that there's no way to know what occurred until after it's happened, and there's no way to predict when it'll capitulate. However, more reasonable and pragmatic traders may be aware of specific real-time cues that enable them to calm down and regulate their emotions while the dumping is in full flow. When crypto assets have been declining for some time and trading volumes suddenly spike to higher than average levels, typically after a hammer candlestick is printed on a chart, this is generally a good indicator of possible capitulation. Still, it is not a hard and fast rule, as with all technical analysis. The only way to determine whether a surrender event has happened is to wait until the dust has settled and the next consolidation phase has begun. Those who hold during moments of huge negative volatility are described as diamond-handed, while those who sell at a loss are mocked as having paper hands. Traders with diamond hands, on the other hand, usually emerge out of collapses in a much better position, particularly if the market makes a swift and unexpected turnaround. Is there a method for crypto fans to safeguard themselves from the anguish and sorrow that a crypto market implosion may bring? Fortunately, there is, thanks to Bumper, a DeFi protocol that will debut in Q3 of 2022. Bumper enables crypto holders to insure their crypto assets, ensuring that if the price of a crypto asset falls below a floor established by the user, it preserves its worth at that level, regardless of how far it finally crashes. However, you won't lose out on the upside if the market rips again, hitting dizzying new heights. Bumper's unique price protection procedure allows you to rest easy, knowing that it will protect you regardless of the market's path. The cost of this protection is substantially less and simpler than utilizing basic stop losses or purchasing put options to hedge against the downside. Bumper's mechanics are really rather simple on the surface. Choose a floor and a period duration to protect your assets, and then lock your coin inside the Bumper smart contract. This gives the user a bumpered asset, which is a representation of their current location. For example, if you deposit one ETH at $2,000 in the protocol for 30 days at a 90% floor, you will be awarded a bumpered ETH token, whose value will never fall below the floor, in this case $1,800. This implies that if the price of ETH falls below the floor, the contract may always be redeemed for this amount, minus the premium paid, when it expires after 30 days. However, if ETH suddenly rises to, say, $3,000, you just return your bumpered ETH for your original token, and you successfully navigated the volatility once again. Isn't that smart? In a word, capitulation is an unavoidable element of the very volatile cryptocurrency markets, and it may be catastrophic when it occurs. Understanding how to manage risk and avoid falling into the traps set for unwary crypto investors is crucial to be financially successful as well as emotionally balanced. Bumper is a low-cost, high-efficiency approach to shield your pocketbook from market capitulation. Bumper's price protection will be a must-have weapon in the armory of seasoned DeFi degens. Suppose the prospect of experiencing a market collapse does not appeal to you. In that case, you may relax for a day, or a month, or even longer, and safeguard your assets against a sudden and unexpected surrender that might otherwise ruin your day. Well, that marks the end of it all. Would you go on and insure your investment you've made in the super volatile crypto market? Do you think it's a security that one should consider? Please share with us in the comments section. Let us keep the discussion going and share how the crash affected us. Before we finish up, subscribe, like, and share the video as well. Explore the channel for even more similar content. Until the next one, stay tuned and stay safe.